Welcome to Next in Tech, an S&P Global Market Intelligence podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for Technology, Media, and Telecom at S&P Global Market Intelligence. And today, we're going to be coming back into the merger and acquisition markets, taking a look at what's going on in what has been a really complicated year with analyst Melissa Incera. Melissa, welcome back to the podcast.
Thanks for having me back, Eric.
Well, and thanks for coming back. The last time we talked, things were pretty, I guess, shall we say, unsettled as the market was going forward. But I don't know, I actually had heard people earlier this week talking about normalcy in markets, and maybe we were approaching that. Are we there yet? Are we getting there? What's the general state of the market?
Not quite, I'm afraid. Specifically, the tech M&A market. Broadly, we're still down, despite the stock market recovery. But to your point, it's growing more nuanced than that. Certainly, we're seeing definitely some significant signs of improvement as the summer goes on.
Well, I mean, one of the things that you've said in the past is that this really is a lagging market compared to the traditional stock market. That last time we were talking about valuations, there were still all these inflated expectations as the market was really getting hammered, and maybe that's caught up, and we're seeing that lag as the stock market recovers. Similar trends that are starting to follow. Are we heading that direction?
Yeah, I guess so. I can help put where we are into context. The further we get from the pandemic, it's easier to look back, right? And it's increasingly looking like Q1 of this year is going to be where we bottomed out in terms of deal spend in this post-pandemic cycle. So Q1, our database logged about $49 billion of deal flow, which is the lowest quarterly total since 2012. Or to put that in another context, if the entirety of the quarterly deal spend was a deal, it would only be about the sixth largest deal in our database.
Ooh,
so that's where we started
ouch.
the year. Yeah, pretty painful.
Yeah, as we've been talking about this spring.
Yeah, exactly. So now, just about exactly halfway through the third quarter, we've already surpassed that deal spend. So there's certainly some heft returning to the market. We're actually starting to see some bigger deals again, specifically some 10-figure deals done by strategics, which just wasn't happening earlier this year. So there are some sizable gains and some traction coming into the summer.
So, and the strategics had basically been on the sideline as we were rolling through the beginning of the year. There wasn't much in the way of activity there.
Exactly.
Alongside the strategics, what kind of deals do you see is happening? What's the characterization of where things are and what's taking place?
That is a great question. Broadly, we're seeing three main types of deals happening at the moment: consolidation, emerging tech, and capitulation type deals. We'll start with the first, which is the mass bulk of the market at the moment, because broadly, this is an excellent market for companies of all sizes to buy up market share, technology, competitors, et cetera, particularly because there was such a proliferation of startups in the last few years, and now venture capital is so hard to come by, as we talked about last time you and I chatted. So a lot of companies are in dire straits, and some of our Voice of the Enterprise data shows that particularly for application software, buyers are growing more conservative. They're looking to consolidate their tech stacks. So a lot of these vendors are deciding, hey, we can float better together than we can apart, which is contributing to this massive uptick in this type of deal. Actually, we speak with a lot of bankers. A lot of them are calling this the year of the add-on deal, because there are so many instances of larger startups acquiring smaller, and it's happening across virtually every sector.
You were talking about application security on our last episode and application area in general. And as we keep saying, in the security world, there are all of these organizations that are out there that are really sort of more individual pieces of functionality. So it seems like in that market, maybe the sanity of consolidation starts to make sense. You start to bring some of these individual features together in what is now a much more full-fledged product. But I'm interested about your point about that shift in buyer perspective, because that is something we see broadly, which is that buyers are looking to be able to work on platforms, the patience to have lots of individual component pieces that they've got to manage individually is starting to wear a little thin. It seems like that really is pushing that consolidation play.
Yeah, actually, so that's a perfect segue. So to your point, the conversation of, is this a feature? Is this a standalone platform, is super relevant right now, right? Because it's an environment that's not necessarily going to support those standalone products for too long. And then secondly, so you led me into the capitulation type deal.
which just sounds sad, but this is the reality. And I guess both you and Brent Daly have been talking over the course of the year about the fact that there were these lofty expectations, and I guess I alluded to it with my comment about the lagging nature of expectations in venture markets and sort of where founders were and their thoughts about what they really were worth. But when you bring up the term capitulation, I guess we can see where that's going.
Yeah, no, and these are not as fun to cover, but this is where we're seeing a lot of sell-offs and divestitures as companies are deciding to slim down and really focus on what they do best, optimize for profitability, et cetera. So it's interesting because we're seeing this year a lot of overturning of really big speculative deals that companies have made in the past. My favorite this year, Shopify sold off its logistics unit. It spent $2 billion in the last 2 years. So really quick turnover for that one, and probably took a massive loss. Twilio has been divesting. I think it divested its IoT business most recently. Google divested its domain business. And these are often very low multiple deals, but they're happening with an increasing frequency as a lot of businesses just look to optimize and to strengthen core businesses.
Oh, see, I was thinking capitulation was maybe you had founders who were finally seeing that their valuations maybe were more rational. But the other aspect of capitulation is actually figuring out what you're going to do as a business and shedding those chunks of the business which don't make as much sense. If Shopify was looking to be the next Amazon, running your own logistics environment is probably a sensible way to do it. But if you have realized that maybe that's not that you can't necessarily be everything that Amazon is, suddenly the light bulb goes on.
Yes, and then making this environment even more confusing and contradictory, then we have the emerging tech deals where, these are the hot areas where acquirers are still paying really robust multiples, generative AI.
Oh, you've said it. Oh, I was wondering how long we could hold off on the podcast before going to Gen AI, but there it is. All right. I suppose we have to, but
we must.
Well, with the furor and the pervasiveness of every conversation having Gen AI in it, we're just about to enter the fall conference season. I know our team's been doing a lot of the pre-briefs, and there's just so much generative AI discussion, but it is also driving deals.
Yeah, and I can toss out some other emerging tech areas. Private 5G is the other one. AI-enabled security is another one. So these are areas where users are just really eager to get their hands on this tech and start spending in these categories. And it's actually accelerating the M&A curve for a lot of these categories, which is really cool and interesting to watch.
Well, the private 5G one is one of those interesting things that I think a lot of us would have said, a year ago, this is going to be amazing. But it's it's a story of an emerging market, of the technology finally maturing enough, efforts like Open RAN and a lot of the individual telco equipment manufacturers getting there, but also having this really interesting crop of early stage participants in this market who are playing as part of this as well. So
yeah,
a part of that, the 5G, that's the piece that's near and dear to my heart, but so many different aspects that are going on.
Yeah, and it's really interesting because in a lot of subsectors, all three of these things are happening at the same time, which is why it's so strange and hard to define the state of the market. So if we look at, for instance, the payment space, we had 4 or 5 months go by without a sizable deal. Mostly consolidation type deals because this sector in the public space was hit really hard. Valuations were really hard hit.
Yeah, but one that had been hot, but then you got like the Klarnas laying off people and some pullback and some other things. But refocus in that area?
Yeah. So in July, so basically nothing for a few months. In July, we hit, within a 10-day period, we have Visa picking up Pismo at $1 billion valuation, which is presumably a great exit, that speaking to that emerging tech component, followed very shortly by Fidelity National, which sold off a majority stake of its own payments unit, WorldPay, at a massive valuation loss. So within a week's time, you see a great exit and one that's a little bit harder to swallow.
Huh.
Hot and
Blowing
cold at the
hot
same
and
time.
cold. That is
Right.
wild. Yeah. So
Right.
upside on the one, and maybe, again, a realization that they weren't heading in directions that made sense for them on the other.
Right.
Wow. I
Right.
mean, the pendulum swings back and forth in the same week.
Yeah, exactly. Exactly. And that's the kind of the conundrum we're in right now.
Wow, interesting. So, around that, with so much activity on that end, are there things that aren't taking place? Or are there deals that just aren't going down?
Yes, large deals. We're starting to see some, but not remotely on the order of what we were seeing the last few years. Compared with where the top of the market was last year, just looking at the total value and number of deals over $1 billion, 10-figure deals, we are down year over year, 2/3 of the number of deals over $1 billion, and we've posted just a quarter of the value. Basically, it's just a hard time to make things happen at the moment, especially at the high end of the market. The financing landscape is tough. The regulatory environment is tougher. Buyers have a lot to factor in, especially public buyers, where big deals have been quite heavily penalized. So we've been seeing a lot of banks and buyers shifting down market, where it's a lot easier to get a deal done. And the impact of that is that the mid to low market is actually looking relatively robust. There's not as much spending happening, but there's a ton of deal activity.
Huh. Well, that's interesting in that the nature of those deals is changing. One of the things we keep bringing up is the market's adjusting to the fact that you're now actually having to pay for money with interest rates that are up, that in fact, that whole process of the deal itself is shifting. I mean, is this something where you see that the logistics of deal making are changing?
Yeah. So when we talk to bankers, they're super busy right now. They're all working on a ton of deals. They're saying pitches are up. The challenge right now is in the logistics of deal making, as you say, because there is a lot of skittishness from buyers, particularly. And there's a lot that's just not getting across the finish line. If there's something off, buyers are quick to let go. If there are legal challenges, if something appears that is unexpected, there has been a lot of press about VCs getting into trouble for their lack of due diligence in the last few years. So I don't know if you caught SoftBank just sued one of its portfolio companies. It's a messaging platform called IRL, in which they invested $150 million at a $1.1 billion valuation. And the company just admitted that 90% of its reported users were fake.
Yeah, it's one of those things that in the heady days when everybody was moving forward and there was lots of velocity, you could maybe skip over some of those things if, in fact, growth was sort of picking up. But a lot of those things that were used to stimulate growth, if you can't sustain it, now come back to bite you in some pretty significant ways. And that's, again, in a challenging market. But it is interesting that when buyers are being that cautious, I mean, it's now moved not only being cautious, but in the SoftBank situation, that's something where they're really starting to reopen and examine that deal and take a look at, all right, if it's not going the way we expected, what happened? But it seems like it's something that maybe is driven by concerns about where the market is. We've gone through this period of everybody figuring that we were going to be heading into a recession. Now the thought is maybe recession light, maybe soft landing, maybe things are okay. And in fact, maybe we're seeing some indications that say we're not going to have a recession. And all of this uncertainty about where the markets and the economy as a whole is really going. But what you're identifying is that everybody's still not really convinced that we've got a solid base from which to work. And if things go a little sideways, that's just one more thing that's making people even more nervous.
Right. Exactly. To your point, it's definitely a positive thing that there's more due diligence happening. This is definitely a behavior correction.
That's a very polite way to put it.
Yeah, but it's definitely impacting the way even the deals that are in the pipeline, how they're happening, right? We're seeing more deals that involve more contingency type payouts, right? So a rise in earnouts, a rise in covenants that essentially put more protections in place for the buyers and more guardrails in place for the sellers.
They're going to do earnouts. They're going to make sure that if the deal is contingent upon actually really making money or selling stuff. So, yeah.
Right.
As you said, healthy corrections.
Healthy corrections, right. It's impacting deal flow, and that generally deals are just taking longer. They're getting delayed. And we're hearing that there is a large backlog of deals that are either waiting to be announced or waiting for the kind of the ideal time, which we don't, when is that going to be? Who knows? But the ideal time to green light.
Oh, interesting. So again, it speaks to that hesitancy of, people are still a little unsure, but hoping that maybe this goes forward in some way or other. In terms of other parts of the market, we've also talked about, talking about pendulum swings, private equity and the kind of thing, the in and out of the market, levels of activity and those sorts of things. Where's the private equity side of this story playing out? Where do you see that?
Yeah, actually, my colleague just wrote a great report about this. So I'm going to give him some credit here. Brennan wrote a report called The End of Private Equity's Golden Era, which was a really great deep dive into the kind of the historical PE buying cycle. And essentially what he's saying, and the data supports, is these acquirers are built to buy, and the rising interest rates have hit them really hard. Fundraising is slowing, as I think we talked about in our last episode. And investors are not as free flowing with cash. This has really dampened the kind of activity we're seeing from PE. I believe in Brennan's report, he said inflows in terms of fundraising are down 20% from 2021. And on top of that, the tech industry is seeing slowing growth rates generally. So it's making the math a lot harder for these buyers. And it's looking like this will be the first year in about a decade that we actually see a decline in spending from PEs as a lot of them reorient themselves.
Interesting. Well, interest and interesting. Well, I think as you brought up, it is that adaptation of the market, and especially when PE, in terms of fundraising, was a great opportunity when there were challenges in terms of getting decent returns in other places. But now that people are getting decent returns, now that there's maybe a little more belief in the stock market, lots of other ways to be able to get reasonable returns on your investments, they're not the shining stars that they once were.
Many of their portfolio companies are getting a bit long in the tooth, right? So they've had this period where they've spent, and they can't keep buying really without showing returns.
Yeah, they've got to get to a point at which they cash out. And
Exactly.
the PE model is that you buy, you hold, you grow value, then you sell, and you get a return. But if you've been holding for a really long time, maybe those investors in your funds are starting to get a little itchy for when they're actually going to get some returns on their investments. So an additional complexity.
Exactly. Yep, that's exactly right. So we are starting to see a few of them, specifically kind of the leaders in the space, Toma and Vista, are starting to look for exits. And they've done pretty well this year. I think Toma's exited about $15 billion worth of portfolio companies this year, which in comparison to where it was buying last year, I think last year, sum total, it bought about $30 billion worth of tech targets. So 8 months into the year, the fact that it's exited that substantially is pretty impressive. And the valuations have been substantial, which actually speaks to the fact that, again, as we've spoken many times about the flight to quality, but the opportunity for businesses that are really well run, that are profitable in this market is actually pretty healthy, is pretty substantial. Who knows? We could potentially start seeing more exits and more heft at the top of the market driven by these PE exits that frankly just have to start happening.
And if you're a company that's behaving well and isn't getting out over your skis or overextended, maybe in fact there are opportunities for you.
Yeah.
And especially in an area that has been such an active area for tech, private equity has been one of those, I was going to say bellwether, but with the ups and downs, I guess we can hardly really call it that, but at least been something that's offered an opportunity in terms of so many different tech deals.
Mm-hmm.
But I was wondering, what do you see for the end of the year? Where are we headed as we look towards that fourth quarter? I mean, we see there are some major IPOs that are maybe on there. People keep talking about what's really going to happen with Instacart. Is the IPO market going to come back? Or where are we headed?
Yeah, again, I think the hot and cold kind of pattern is going to continue, right? So we might see some IPOs, we might see ARM go, likely we'll see ARM go, but I don't think that necessarily will bring in, will break down the floodgates in terms of tech IPOs. So I would anticipate we're likely to see the same types of patterns continuing, maybe with some more activity at the top of the market.
And maybe a rebound to some of those big deals that have been holding off.
Right.
I guess we'll have to see where things go as the year shakes out.
One of the most interesting dynamics that we really haven't paid much lip service to is the fact that there are more buyers than ever in the tech M&A environment. We've seen corp dev operations crop up in businesses smaller than we used to see buying a few years ago. So there's a lot of demand specifically for high quality companies. I expect we're going to see deal flow continue to be really robust. And as we were talking about, just more activity specifically on the high end of the market as buyers become a little bit more comfortable with the current state.
And maybe some of those big deals really start to turn up. Some of the things that maybe have been sitting on the sidelines a little longer. Well, we'll have to see what shakes out in the year ahead. Well, thanks for all this, Melissa. This has been great.
Thanks, Eric. It was so much fun.
Well, we've got a lot to look forward to as we roll into the end of the year. But we are at time. That is it for this episode of Next in Tech. Thanks to our audience for staying with us. And thanks to our production team, including Carolyn Wright and Ethan Zimmon on the marketing and events teams, and our agency partner, the 199. I hope you'll join us for our next episode, where we're going to be talking about AI data centers. Yep, we'll be right back into AI, into the thick of it. I hope you'll join us then, because there is always something next in tech.